It's a bull trap. No, it's a bear trap. That's all a trap. In today's abbreviated episode of the Midweek Market Update, I just want to continue to reinforce one major data point, which is that you should not try to be a hero inside of this box right here. And the reason for that is that we really still have two conflicting viewpoints on this market. So the first one, very simply illustrated, is using a trend line coming from here. We can see that it's still possible the market sets a lower high up against 595.75. And classically, a lower high, of course, would be a bearish indication. And the next check that we would just look for is, are we coming from a higher low or a lower low? Well, I don't know about you, but this is the lowest low in the trend count. So that's technically bearish. Now, on the flip side of the coin, of course, if this is a balance range right here, then technically Monday offers a look below and fail, where we closed back inside of the range. Put yourselves in the shoes of a seller, right? On the Monday morning gap down, what's the ideal outcome for a seller? A gap fill reversal, which keeps price underneath, at best, this level here, 580.75, the bottom end of the balance range. Clearly that didn't take place. So do we have stronger sellers there? The answer is no. What about Tuesday? Tuesday also is a gap session. We open on a gap up and we fade. We actually fade right off of a pretty key level here at 584.75. And we look into the Monday range, we actually break down, and we can see this in the lower wick here, right? We break down underneath 580.75, but where does that daily bar close? It technically closes above 580.75. So the question becomes there, if this is a look below and fail, what's the target? Well, classically on a look below and fail, the target is always the opposing end of the balance, which would suggest about 603, which is bullish. But Matt, you just said that we're coming from the lowest low and there's an opportunity for a lower high. I absolutely did. So the point still stands that in this box, anybody who's making bold, aggressive calls, those are the people who are getting run over by this market. Anybody who shorts the gap down here, anybody who sort of bought the gap up here. I suppose buyers who got involved on the gap up this morning were somewhat rewarded. And I would say after this move that has failed to materialize lower off of the Monday and Tuesday sessions, I would tend to think that there's a subtle bullish edge in the market right now, but please be mindful of your trade location. If you're not holding things overnight and you're trying to establish new positions in the midpoint of a balance range, I'm not convinced that you really have the best trade location in this market. So what are the ideas? What are the outcomes as we walk forward? Well, again, there's probably a slightly bullish edge here to the market because on this gap up this morning, you can see that there's a subtle little lower wick right here, which indicates that we moved underneath the opening print, but the sellers were unable to close the gap all the way. So do we have stronger sellers participating in the market? The answer is no. If we can see prices consolidate and accept over 591 in this area here, I would tend to think that there's an opportunity for maybe some sort of a bull flag which breaks that resistance trend line here, and the way to participate would be on a Brigade bolt here, set the higher low intraday over 595.75, invalidate that level as a lower high, and trade for the equal high up around 603, which would be the completion of the look below and fail, correct? Now, of course, the downside takes care of itself. If we move into this gap, because it's such a substantial range, there's easily a Brigade bolt intraday that could unfold where we could look to take a short on a lower high underneath today's low of day, targeting the full gap close at 584.75. Before we go down to the hourly time frame chart, I do want to navigate to the weekly because this is another place where there's been some pretty severe push and pull. One of the things that we had mentioned in the weekend update was that definitively last week's weekly bar had finally closed underneath 585. And we actually opened Monday's session on that gap down well underneath 585. But look at where we're trading currently. Obviously over 585. So again, it's not as straightforward as just, okay, big short, big long in the market. It's going to be this easy trade in this range. Absolutely not the case. The weekly is flip-flopping in terms of its indications here. We just saw on the daily time frame chart that you have some flip-flopping of indications here. And really the only thing that makes sense or would have made sense is being long overnight as of Tuesday's close, recognizing the failure of the sellers to keep prices underneath 580.75 and then waking up to a substantial gap up this morning. If you're not already long from down here where you have some semblance of risk reward to the upside, again, chasing it in the midpoint of this range doesn't really leave you with really great risk reward location, trade location as we move forward. Let's take it down to the hourly time frame chart real briefly. and see what else we can learn. So, of course, the pattern in play is sort of this inverted head and shoulders. And once again, if you went out on Tuesday long, that sort of makes sense, hoping for that neckline break. Obviously, you were rewarded with a bit of a gap up here. But even beyond that, like, what's the trade ideas going forward? As we mentioned on the daily chart, you sort of have to be a little bit patient through this area here. I don't think it makes sense to just be a blind new money long at the upper bound of the weekly expected move here at 592.21, butting its head up against the daily 50 SMA with resistance overhead here at 595.75. Again, if you're not long from this location, you're basically fighting for, risk. You really have to put a stop underneath previous day's low, reward into that resistance. If you're lucky, maybe it balloons up into that 603 target, in which case, if you can find the hold of 591, maybe you have a trade idea that looks like this over time if you're willing to hold until it ultimately comes into that 603 target, in which case you probably have a very bullish stance on the market via this gap up, which, once again, in my personal opinion, I think it's a little bit of a bold request inside of this balance range, with as well this potential resistance trend line going to offer some trouble into tomorrow's session at 595.75. So I'm taking a very balanced approach here. I'm taking it session by session. I'm not going to be calling any major shots for like huge longs, huge shorts inside of this area here. It's really one day at a time as things develop. So if we look for additional supporting evidence, let's quickly throw on the intraday anchored view apps and see what we have here. You're above the entirety of the stack now, which of course is bullish. And I would say the biggest recapture here that is notable to me is the combination of the Jerome Powell plunge anchored view app and then the gap down open anchored view app over here from that Friday session that followed it up, right? You could maybe argue that this is the next most important. Regardless, you're over the entire stack. However, the all-time high anchored view app is not as important as these two down here. As long as we're over, once again, today's low, I would tend to think in the short term, the bulls have a little bit more of that edge as we walk forward. If we take a look at the market internals, if you're not familiar with this, check out the video tutorial in the top right-hand corner. What do we see from today's gap up? Obviously, it was a CPI catalyst, but how did the exchange level performance do? We had substantial volume inflows, which is bullish. We have huge degrees of correlation in the upward direction, which is bullish, but also an indication of volatility. Don't forget that, right? The more correlated a market is, the less the ability for a rotation to take place and have the price action sustain itself in the upward direction in this case, right? The index scored pretty decent intraday, as well as this, the most notable cumulative build we've seen out of the tick in a very long time. Even as the market's been sort of wild inside of this range here, the cumulative builds have been fairly muted. I think that the worst we've seen was like negative 3,000, negative 3,300. Best we've seen was closer to like 2,500. So this is notable to me, seeing that the cumulative built out to up against, what is the high of day there at the very end? 4,800, just a couple hundred points shy of 5,000, which we consider substantial. So at the exchange level, we are seeing what would seemingly look like new money buyers stepping up at that point. Let's skip out on market profile for now. We'll quickly take a look at the NASDAQ. And again, in the sort of spirit of keeping this slightly shorter than normal, here we go. On the QQQ, right, we can see that the magic level, and this is really what I talked about on Saturday, I was going to say Sunday, but Saturday, as being one of the data points out of the multitude we were seeing that were bearish. This one was still bullish, right? The fact that we were still over this previous all-time high at 503.25. And that call all by itself has sort of prevented me from getting ahead of myself on the short side in the S&P. There's a great individual trade on Tuesday, but there's really no reason there to be swinging for the fences on a big breakdown, noting that on Monday, QQQ gapped underneath 503.25. And if I even take this to a 5-minute time frame chart, check out how accurate this level was, right? If you look at Monday's session, intraday resistance, 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 then flipped to support, It was holding all through here. So 503.25, that previous all-time high, an absolutely key level for the NASDAQ, was recaptured after that gap down. If the Monday session had closed weaker underneath the opening print, well underneath that 503.25, let's make sure you can see that. There it is. That would have been much more of a short signal. But the fact that Monday closed back above that level, not the case. The market's still holding on to that QQQ reference point. So if we just go back to the daily chart after resetting that to the hourly, what do we see here? It's really the same mantra as the S&P 500, where you have This range has now experienced a look below and fail, catching support off of that key level, which we just described. And now it's just a matter of, excuse me, if we can hold up, excuse me, inside of that 510 range, if we can set a higher low over 510, now that look below and fail is solidified on not just this level here, looking under the 503.25 and then failing back above, but the balance range from in here as well. The bottom of the gap down from the Friday that followed the Powell plunge here, which changed the tone in the first place. Now, I'll continue to balance that argument with perhaps this resistance trend line here in the QQQ. Absolutely, that still offers a bit of a threat. It's kind of in no man's land. I do think that the resistance trend line is a little bit of a stronger argument in the S&P 500 because of the way it ties in with that horizontal level as well. So you could watch this here in the NASDAQ, but really, I would still think that a lower high can persist, technically speaking, underneath 524.75. I would be bullish on holds that come in here and support, right? Looking for risk reward ultimately to today's high of day. Let's go to the hourly chart to map out these risk reward ranges here. If the market pulls back, right, and we can catch a gap fill reversal here, it would be risk reward back up to today's high of day. If the market Brigade bolts up and out of this level, again, maybe we look for something along these lines, risk and reward. If you're like, no way, this market is going to reject the resistance trend line or it's going to have an early rejection, what I would look for in that case is, okay, we break through the level, there's no higher low above, there's a lower high underneath, in which case you could say risk and now reward for the gap close to the downside. That would be back underneath 517.75, right? As close of an entry to here as possible with a stop reasonably above that lower high. So there's, again, the mantra, the motto of this market, for me at least, you do whatever you want to do, but I really think the traders who are rewarded through this are the patient traders, are the traders who take this one step at a time, one day at a time, don't try to make any big bold calls. As we've said in the Saturday video, as we said in the midweek market update from a week ago today, it's really the difference between a trader with a 20-year career versus a 20-day career is understanding how to manage risk and adapt to the changing market conditions that we're dealing with. Obviously, this is a volatile market trying to break down, failing to break down, possibly setting a lower high. Maybe it breaks that lower high. So really, day by day is the approach. And if we can make it through this period back to a cleaner trend where the weekly and daily trends are back in sync, it's really where we have stronger odds of continuing to see trending success in the market. If we jump on over to the NASDAQ market internals, what do we see here? It's the same validation. You get strong inflows. You're over trend higher zone. So again, it's bullish, but keep in mind that correlation leads to volatility, and you finally have a decent cumulative build here as well. Quick check-in on the IWM, and then we'll talk fundamentals briefly before jumping into our supporting evidence. We'll just quickly jump through those charts, and we'll skip the core list of companies. If you're interested in seeing the analysis on the core list of companies, you can either follow us over on X, and we'll post some charts later on this evening, or come out to the morning show, right, the pre-market prep, tomorrow morning at 8 o'clock Eastern. If we take a look at the IWM, let's go to the daily time frame chart. First thing I want to emphasize is that we are still underneath the weekly lower high threat, 227. Resistance, 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 acted as support. Now resistance, resistance, resistance has the opportunity to do it again. Undoubtedly, there was a strong gap up from what was the beginning stages of a bear flag breakdown here to now being back in the range. Notice that we gapped over the top of the range, which is really this box right here, but we've closed right back underneath 224.25. A stronger market, in my opinion, would have played more nicely with the S&P and the NASDAQ closing green over the opening print. That was not the case. The opening print basically marked the high of today's session out of small caps, which leads me almost, it's a great segue into the fundamentals almost here using small caps, because I'm not sure, and this probably aligns a little bit more so with the bearish thesis, right, which to me is more conflicting data. I'm not sure that the CPI print this morning is as bullish as the market perceives it to be. Now, of course, who am I to tell the market what to perceive, right? The market's going to do what the market's going to do. But my thought there is, if we just quickly take a look at what's actually happening here, the core inflation rate is notably, 0.2 is fine on the month over month, but this hardly saw a meaningful downtick. Yes, we beat the expectation here of a 3.3, but only by about 10 basis points. And if you look at the non-core, it came in at the expectation, which was 2.9, but that's still 0.2 of a percentage point over the previous. So when we think about, is inflation trending towards 2%, the Fed's target, I mean, this hardly made much progress. Yes, it beat the expectation, but it hardly made much progress. And this met the expectation, but was actually indicating acceleration of inflation, right? And you can just clearly see this if I bring up this chart over here. Let's click into the, this is the previous week. Let's go to this week. And if I click into the year over year chart, what we can see currently is, if I scroll this over, the reacceleration of inflation. Again, the call is not that this goes back up to a crazy read of like 8.9%. That's not at all what I'm saying. But is inflation really moving towards the Fed's desired target becomes the question, and directionally as just a vector, the answer here has to be objectively no. It's not moving closer to 2%. So although expectation-wise things might look and feel good, and we can see this over here as well, the expectations of a Fed rate cut bounce back to the June timeframe instead of September, like we had on the Monday session. So the market's perception has gotten a little bit better, but objectively, we're not trending in the right direction out of inflation. And of course, my belief is that small caps are most accurately reflecting this, right? Where they opened on this gap up, but ended up fading off and closing weak through the session closer to the lows, not closer to the highs. So if we just go back over, I know we're flipping screens quite a bit here, but if we look at the detailed report of how inflation actually came in, take a look at your shelter component here, which still month over month is at a 0.3. Annualized, we're at a 4.6. That's not really going to get us yet to a 2% goal, right? Shelter is a huge component. It's like close to 40% of the inflation metric here. So to see that not aggressively moving lower, I don't see the argument currently for everything's fine and dandy, inflation is totally under control, it's going to be no big deal. I get that the rent is sort of that delayed year over year timing wise, but it's just not. It's not sitting well with me, the fact that this is not rolled over to a 0.2. We're not even seeing like 0.1s on normalization. It's not there. So that is a concern. And then, of course, the volatile energy component is the largest contributor to why inflation maybe saw an uptick on the non-core year over year, just due to this component from the energy piece. So if this seasonality does end up coming back out of inflation as we go forward, that could potentially help. But until shelter ultimately abates and we get this number much lower, I think it's a rough path to say that the Fed has, basically won the battle on the inflation front. So we've spent some time there. In terms of other fundamentals to pay attention to, we had JP Morgan report earnings before the bell. Generally, financials were up today. We'll briefly look at the XLF sector. Keep in mind for tomorrow, TSM will set the tone for semiconductors. That will be a big issue, not a big issue, but just a big thing to watch. Let's quickly rip through a couple of supporting evidence charts, and then we'll be on our way for the big night here. We do want to jump into risk on versus risk off, the summary charts. These are conflicting, right? At one point, we had bullish reads 4 for 4, all set, right? At this point, XLK-SHY has the opportunity for a lower high. Unfortunately, you're not checking 4 for 4. You might be checking like 2.5 for 4. This is definitely bullish. This is definitely bullish, still over that 50 estimate. This is a good rebound, but after setting this high, you probably didn't want to see a breakdown underneath this previous low. Right? This sort of like equal highs now pulling back to the 50 at least gives the opportunity for that to persist in the upward direction, whereas this is much more of a failed breakout, right? So that's one possible idea. Sneaky thing to keep an eye on, of course, is Japanese yields. They continue to move in the upward direction as they're sort of toying with their interest rates over there. That should put pressure on U.S. equities if this aggressively moves higher, the yen carry trade, right? If we quickly check in on interest rates, yes, rates pulled back aggressively today on the at expectations and beating expectations on the core year over year. But think about this from a technical perspective. What have we done here? We've just produced a pullback into a potential area of support if ultimately bond sellers end up stepping up again and sell bonds, causing yields to rise. That would be, a pretty darn good spot to do it off of 4.65 in the 10-year here. So if this does end up catching support, that would side a little bit more so with the bears. As we come through some of these additional indications, TLT is not signaling a risk-off rotation as it's currently sort of on par with the gap up here. We'll see how that resolves tomorrow. Another quick one would just be to look at these bonds here, which makes total sense that they're down on the session, but still in overall uptrends. This, to me, is the market telling us that, yeah, today was okay from an inflation standpoint, but we're not out of the woods there yet. So that's that one. That's a little bit more bearish than bullish. Something that is more bullish than bearish, though, is, of course, credit spreads moving back in the downward direction. We called out how that this was somewhat divergent from this on the weekend video, coming a little bit more so into, what would you say, parity, with them both moving to the downside, but not out of the woods there yet. Still seeing a volatile market here with credit spreads positioned the way they are. HYG, the higher low, is offering that bullish divergence, so all set there. But let's take a look at corporate grade LQD. Not yet over this equal low. If I just do something that looks like that, if this rejects here, that would be a pretty clear-cut indication that you're probably looking for that lower high from the trend line we talked about in the S&P 500. So LQD, if it gaps up tomorrow, might be a supporting piece of evidence for bulls. If it remains underneath this shelf at roughly the 106.50 handle, then we'll be looking for downside, right? Let's quickly check in on the good old BTC. Still signaling risk on over here, and you're actually getting a flip on the Saylor Shift ratio. If that can end up closing the week out, because this is really supposed to be drawn from a weekly view, a closed weekly bar. If it closes green, we'll change back to being bullish here and not look for that pullback anymore underneath the lows of the weekly bull flag. If we come into total breadth, subtle improvement out of breadth today, seeing an uptick here, and actually more new highs than lows. Again, you can start to see how you're getting a little bit of that mixed bag of data points, which does not make our job easy as traders, which is okay, right? It's really what you do with that information. It's okay to not know in the market. You just need to understand that when you don't know, you should probably take it day by day. You should reduce your position sizes. You should not try to be a hero out there in the market. Let's quickly check in as well on volatility, because this is something I think that actually sides with the bullish argument a little bit more. You're getting, not that you would ever apply classic technical analysis to the VIX, but, mean reversion probably likely now that CPI is in the rearview mirror. Trendline break. Looks like we could easily head underneath the 15 handle. If we check in on the VVIX, oops, that's the same chart. Let's go VVIX. You can see here back underneath that 103, which marks off the bottom end of a pretty key zone. This is where we're on edge about the market. This is a little bit more comfortable here. And then most importantly, we added this chart into the mix in last Saturday's update video, which just basically shows us a number of different timing expirations out of the volatility futures. On Saturday, we were very close to a backwardation in the furthest back month comparison. Now these are all back in the upward direction. What would that indicate? That money managers see in the present day there is less risk as compared to some unknown future. This is where money managers like to allocate capital instead of be a little bit more defensive and reserved. So this is actually much more of a bullish data point, seeing this bounce off of the zero line in the longest dated expirations that we're tracking in this particular metric. So the moral of today's story is that inside of the balance range in this good old S&P, our home base, our good old faithful, I think we want to maintain diligence in terms of making sure that our trade location is correct. I think that we want to be on the lookout for maybe a small bullish edge into the end of the week if we can hold on to the low of today's session. As long as this gap remains unfilled, that would be more of a bullish indication to me. As long as we remain over 585, the weekly chart is recapturing a key level. That's important as well, which basically means if this gap does close and we find buyers here, that would be the first spot where you could potentially look for a daily higher low, which preserves the recapture of the weekly level, right? So there's a number of ways to look at this. It's either consolidation here remains bullish, Brigade bolts we can participate in over this 595.75 if the trade location makes sense for risk reward. If you're trying to short this, you want to look for the Brigade bolt into the gap, in which case, again, every single trade is at face value. It's its own independent trade in a vacuum, risk reward. When we close the gap, if we close the gap, you could then flip the script and say you want risk reward, right? So it's really all about maintaining these key levels, taking everything at face value and not falling victim to trying to be a hero in the range and really getting caught on the wrong side of the trade with too much size and no clear exit plan. So that's what I've got for you in today's abbreviated episode of the Midweek Market Update. If you tuned into the morning show, you know where I've got to go. So we're off to go do that. If you had a fantastic time in the market today, if you're enjoying the balance range in here, let me know in the comments section. If you learned something new in today's video, if you're a new viewer tuning in because it's a shorter episode, let me know as well. Do you enjoy the shorter episodes? Maybe we should just do this as the status quo for Wednesday videos. Let me know. Open to feedback. Hopefully you guys had a great trading session. We'll see you back tomorrow on the channel here, live for the pre-market prep, 8 o'clock Eastern time. Have a good night, and I will see you in the next one.